This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Example 3, very much the same idea, but read it carefully. P acquired 100% of the share capital of S for 60,000. And before we go any further, look at the balance sheets. P's balance sheet. As always, in its own balance sheet, you've got as an asset the cost of the investment. If they paid 60,000 for the shares for whatever reason, credit cash, debit investment, debit the asset, 60,000. Clear? So that's what we paid. We bought it on the 1st of January 2005, and it says on the 1st of January 2005, the retained earnings of S were 15,000. So what were we buying? Obviously we were buying the shares in S, but because they'd already earned money, we expected to pay more because they'd already got the earnings, we were buying the earnings. True? It also says, though, the fair value of the non-current assets was 9,000 more than the carrying value. Ugh. What do I mean by that? What I mean is this. Forget this question for the moment. Suppose you were buying my company. And suppose I told you, in my balance sheet, I'm very tiny, I've got assets, a car and a few computers, I've got assets in the balance sheet of 5,000. Okay? However, even though in my balance sheet it says 5,000, surely if you were buying me, you're not just going to say, oh, right, I'll pay 5,000 because the balance sheet says that's what they're worth. The amount you'd pay, you'd say, well, how much are these actually really worth? And if these are really worth 3,000, you'll pay me 3,000. If they're really worth 20,000, you'll have to pay me 20. You understand me? That the balance sheet values always are not showing the true value of the assets. Particularly if I owned land, in my balance sheet, it would stand probably at the cost that I'd paid 5. But if that land was really worth 20, surely you'd expect to have to pay 20 for it. Do you all agree? Well, what it's telling us here is that the day we bought it, the 1st of January 2005, the fair value of the non-current assets, so the true value, we decided was 9,000 more than the carrying value. The carrying value is the balance sheet value. So I don't know what was on the balance sheet, but if on the balance sheet the assets were 5,000, we decided when we bought the company that they were actually worth 9,000 more, that we'd expect to have to pay 14,000. Are you all clear? However, we're still a problem. How much did we pay in total? How much did we pay for the shares? Hello? How much did P pay to buy the shares in S? 60,000. It says so in the first line, and there's 60,000 in the balance sheet. What were we buying? Well, we were buying the share capital. The share capital is 10,000. We were buying all the shares. But of course, the company S was worth more than 10,000 because it had already got earnings. The retained earnings at the date of acquisition. So the pre-acquisition retained earnings At the date we bought it, the retained earnings were how much? 15,000. So tell me, please, on the date we bought the company, what was the value of P on P's balance sheet? Look at the screen. There's nothing in the question to tell you. At the date we bought P, on P's balance sheet, what must have been the value of the net assets?
60.
No.
25,000.
On the balance sheet, 25,000. Surely on the balance sheet, although we haven't got P's balance sheet at the date we bought it, on P's balance sheet, shareholders' money was 25. And therefore, surely, the assets less the liabilities must have been 25. Do you agree? So on the balance sheet of P, it was worth 25,000. The balance sheet value but I said a moment ago that if you were buying me, just because the assets on the balance sheet stood at 25,000 doesn't mean you'll pay 25. If the assets are really worth more, you'll expect to have to pay more. You'd agree? And what does it tell us? It tells us that the fair value of the non-current assets, at the date we bought it, was 9,000 more than the carrying value or the balance sheet value. So what are we saying? We're saying, although the balance sheet would have shown the assets worth 25, they were really worth more. How much more? They were worth an extra 9. They were worth 34. We call this the fair value adjustment. Now, I'm not there yet, and obviously for the exam you just learn rules, but it's awful to learn a rule without any logic. But is everybody with me so far? But I'm sorry to keep repeating, but I say again, I think it's awful to learn a rule without having any understanding. At the date we bought S, the value on the balance sheet must have been 25. The share capital plus the amount they'd earned. At the date we bought S, we decided the assets were really worth 9,000 more than what was in the balance sheet. Maybe there was land, the obvious one, which might be worth more. And so, the true value was 34. Okay? But we have a problem. We're saying the true value was 34 of the assets. Why were we paying 60? Well, the heading gives it. But surely, if you were buying my company, you'd say, how much are the assets worth? Maybe my assets are worth 10,000. My assets, you know, the actual physical assets, my machines, my cars, my land, etc. You'd say, all right, maybe they're worth 10. But if you were buying my company, I'd expect you to pay more, because if you bought my company, you can immediately start earning money because I've already got customers and so on. The business is already working. You know what I'm getting at? And so I would expect you to pay more because it's a going concern, a going business. Well, the extra you pay, we call goodwill. And so, since we paid 60 for something we thought was worth 34, it must mean that the extra we paid was for goodwill. That extra 26,000 we call the goodwill arising on consolidation. And the reason we call it that is, do appreciate, that goodwill certainly doesn't appear in S's balance sheet. Never. In S's balance sheet, they're showing the balance sheet value of their assets at whatever the date is. The fact it may be worth more because of goodwill, you never show in your balance sheet. All right? It doesn't appear in P's balance sheet, because all P has in its balance sheet is the amount it paid. It paid 60,000 for whatever reason, and when they bought the shares, credit cash, debit investment, 60,000. But, as you'll see, when we come to do the balance sheet for the group as a whole, we need to know, why did we pay more than it looked as though it was worth, if you understand me? Part of the reason is because we decided the assets were worth more than appeared in the balance sheet. But the extra, the difference between the value of the assets and the amount we paid, that extra must have been for goodwill. Okay? Now, let's prepare the consolidated balance sheet. Watch me carefully. Essentially, as always, we add up. But be careful. First of all, the non-current assets. Appreciate we're doing the balance sheet at December 2009. It's some years later. The non-current assets in P were 82,000. In S are 27,000. Just like always. But, just one little thing. When we bought the company, we decided the assets were worth 9,000 more than in the balance sheet. You remember? Well, when we come to do the consolidated balance sheet, we say, well, if we thought they were worth 9,000 more, for the consolidated one, let's add on that 9,000. The fair value adjustment. So in the consolidated, how much do we get? 82, 109. Is it 118,000? I hope you're checking me. What about the current assets? Well, they're no problem. As far as the group as a whole is concerned, the assets of both companies, simply add them together. P, I've lost it, is 20. S is 12. Total 32,000. However, and I apologise, I should have told you to leave a line. However, here, one new asset is going to appear. That we checked earlier, that when we bought the company, not only were we paying for the normal assets, if you understand me, but we were paying that extra 26 for goodwill. Well, although it didn't appear in the accounts of either company individually, when we come to look at the group, we need to bring it in. The goodwill arising. How much was it? 26,000. Now, as I say, I should have told you to leave a line. I'll have to put a little arrow. For neatness, strictly, it should be up there. It's like an extra non-current asset. But I'm not over-worried the way it's asked in the exam. I'll explain in a minute. But we have that extra asset. So two things there. Basically, you add up, as always, non-current and current. This fair value adjustment, which is actually rare for paper F3. But if the non-current assets were worth more than balance sheet when we bought it, we add it on. More importantly, in the consolidated balance sheet, this new asset appears, the goodwill. Okay? All right, so the total assets are what? 118, 150. Is it 176? Who owns the assets? Well, of course, as always, the owners effectively are the shareholders in P. And the share capital of P is 50,000. But the shareholders in P are owed the share capital, but they also own the retained earnings. Exactly as before, and always the same. They own all the retained earnings in P, 110,000. Together with the post-acquisition retained earnings of S. How much has S earned since the date we bought the company, please? Since the date we bought the shares, how much has S earned?
13.
The total retained earnings are 13. Oh, sorry. Oh, she was right. I beg your pardon. The total retained earnings are 28. However, they'd already earned at the top 15 on the day we bought the company. So how much has been earned since the date? 28 minus the pre-acquisition 15. Sorry, Liga, she was right. Is everybody clear? 13,000. And so the amount belonging to our shareholders, 110 plus 13, I think 123,000. And so the total owing to shareholders is 173. Finally, of course, current liabilities. As always, simply add up 2,000 in P, 1,000 in S, a total of 3,000. And of course it balances, it's beautiful. But I hope you're clear where the figures came from. Now then, obviously in your exam, because you're ticking boxes, they cannot ask you to prepare a consolidated balance sheet. They'll ask for extracts. And so far, two big things, and I hope you're clear with both. The two big things, one is this retained earnings. Whatever's happening, the retained earnings for the group always is all the earnings of P, the parent, the owning company, plus everything in S, the subsidiary, since the date we bought it. Are we clear? You know, I said before, although I hate just learning as a rule, certainly the exam itself, it's automatic. And definitely, whatever they ask or don't ask, there'll be some questions where maybe they give you the information in example 3, but all they say is, what are the retained earnings in the consolidated balance sheet? It's everything in P. It's the post-acquisition earnings of S. Clear? The other important bit so far is this goodwill. That, again, as extracts, they could give you the entire question and say, calculate the goodwill on consolidation. It's always the difference between what you paid and what you were buying. I think you understand what I mean. What you were buying the shares, obviously, 10,000. You were buying the retained earnings at the date of purchase, pre-acquisition. And, less likely but possible, if at the date of acquisition the assets were worth more than balance sheet, this fair value adjustment, the 9,000. So again, you must learn that. But that's what you're buying. The excess of what you paid is goodwill. The 26 will appear on the consolidated balance sheet. All right? Lovely. Well, although we have some more problems, we'll leave them till the next chapter. Can you have a go? Can you look at example 4? Exactly the same idea, but with different figures. And again, although you'll only be doing extracts, I think no problem putting them all together. But can you do the whole thing? Example 4. Can you work out the goodwill? Can you work out the retained earnings for consolidated balance sheet? And let's actually do the balance sheet and check it works. Let's have a go. All right, let's check or finish it with me. And again, get in the habit, I don't mind here, but get in the habit of working them out separately, because as I said before, in your exam they can't ask you, obviously, for the balance sheet itself. It will be extracts. They may say, what is the goodwill on consolidation? They may say, what are the returned earnings for the consolidated balance sheet? So I think you understand me. Make sure you could work out each individually quickly. So just check me, the goodwill, you always compare what you paid, 25,000, with what you were buying. And appreciate the 25,000, they can give it you in two ways. Here I've given it in both ways. The first line says they paid 25, but even if they hadn't, even if they hadn't put that line in, appreciate in P's balance sheet will always be the amount they actually paid. Do you agree? What did they pay for? Well, you're always buying the share capital and the retained earnings at the date of acquisition. The pre-acquisition earnings. If there's a fair value adjustment, without going through the whole story again. But here, they were worth an extra 6 at the date of acquisition. Well, you were paying an extra 6 as well. So, you were paying 25 for something worth 17. The extra is the goodwill. So is everybody happy with the goodwill figure? Retained earnings always is everything in P, the parent, together with the amount S has earned since the date of purchase, the post-acquisition. So all of P is 70, S is 20, it was 6 at acquisition, the extra 14. Again, are we all happy with the 84? Obviously, I will do a balance sheet here, but the consolidated balance sheet, I don't think there's much extra to remember. The non-current assets, you add up. $76 in P, 18 in S. If there is a fair value adjustment, then add it on. The fair value adjustment was, help, 6. The total, therefore, 82.90. Is it 100,000? The goodwill on consolidation. Oh, I thought you were too hot. I didn't think you were still too cold. The goodwill on consolidation, we'd done our workings and was how much? 8,000. The current assets, always a straight add. 12 plus 9, 21. Total, am I right, 129,000? On the other side, share capital. Always the share capital simply of P, the parent company. It's the shareholders in P own the whole group. And so the share capital of P is 40. The retained earnings, we've done our workings, so without repeating the retained earnings, how much? 84. So the total owing to shareholders is 124. And finally, the current liabilities, a straight add up, 3 in P, 2 in S, 5,000. And it balances. Okay? Isn't it fun?